Most people think the goal of a mortgage is simple: pay off your house as fast as possible. And because of that, many people automatically assume the 15-year mortgage is the smarter financial decision. Lower interest, faster payoff, less debt. It sounds obvious, but what if I told you that many financially successful people intentionally choose a 30-year mortgage even when they can afford the 15-year? Why would someone willingly stay in debt longer? Why would someone choose to pay more interest? And which mortgage actually helps build more wealth long term? That's exactly what we're going to break down today, because the answer is not as simple as most people think. Let's start with the basic difference. A 15-year mortgage means you pay off your home in 15 years instead of 30. Because the loan is shorter, your monthly payments are higher, but your interest rate is usually lower, and you pay dramatically less total interest over time. A 30-year mortgage works differently. Your payments are lower because the loan is stretched over a longer period, which gives you more flexibility every month. But over time, you end up paying significantly more interest. Now let's use a realistic example. Imagine you buy a $500,000 home with 20% down. That leaves you with a $400,000 mortgage. With a 15-year mortgage at around 5.5%, your monthly payment might be roughly $3,270 per month. With a 30-year mortgage at around 6.5%, the payment could be closer to $2,530 per month. That's about $700 less every month. At first glance, the 15-year mortgage looks better. And honestly, in many ways it is. Over the life of the loan, the 15-year mortgage may save you hundreds of thousands of dollars in interest. That's real money. And there's also something emotionally powerful about owning your home outright much sooner. No mortgage payment, more security, and more peace of mind. That matters. But now let's look at the other side of the argument, because this is where financially savvy investors think differently. Instead of focusing only on how fast they can pay off their house, they ask a different question: where will my money grow the most? And this is where the investing argument begins. Remember that extra $700 difference between the 15-year and the 30-year mortgage? What if instead of sending that money to the bank every month, you invested it? Let's say you consistently invested that $700 every month into a diversified index fund, averaging around 8% annual returns. Over 30 years, that money could potentially grow to over $1 million. Now suddenly, the conversation changes completely. Yes, the 15-year mortgage saves a massive amount of interest, but the 30-year mortgage may allow you to invest more aggressively over time. And if those investments grow faster than your mortgage interest rate, you could actually build more wealth overall. This is one of the reasons many wealthy people choose long-term mortgages, even when they could pay homes off quickly. Not because they love debt, but because they value liquidity, flexibility, and investment opportunities. They understand something important. Money trapped inside home equity is harder to access, but invested money can continue compounding and potentially generate much larger returns. However, this strategy comes with a huge warning, and this is the part most people ignore. The 30-year strategy only works if you actually invest the difference. That is the key, because most people don't. Most people take the lower payment and simply spend the extra money. Lifestyle inflation kicks in, bigger car payments, more eating out, more vacations, more subscriptions. And instead of building wealth, the lower payment quietly becomes an excuse to spend more. That's why the 30-year mortgage can either be a wealth building tool or a financial trap. It depends entirely on behavior. And honestly, behavior matters more than math. This is why personal finance is so personal. Because mathematically, one strategy may look better, but behaviorally, another strategy may work better for a specific person. For example, a disciplined investor with strong financial habits may do extremely well with a 30-year mortgage and long-term investing. But someone who struggles with spending discipline may actually benefit more from the forced structure of a 15-year mortgage, because the higher payment forces them to build equity faster, it removes temptation, And for many people, forced discipline works better than relying on self-control. There's also another important factor people overlook: cash flow. A 30-year mortgage gives you more breathing room every month. That flexibility matters during job loss, emergencies, recessions, medical issues, and unexpected expenses. With a lower required payment, financial stress is often lower, and stress matters more than people realize. A mortgage should help build your life, not destroy your peace of mind. Now, some people use what's called a hybrid strategy, and honestly, this may be one of the smartest approaches. Instead of locking themselves into a 15-year mortgage, they take a 30-year mortgage for flexibility, but voluntarily make extra payments toward principal whenever possible. This gives them lower required payments, emergency flexibility, and the ability to pay the house off faster if they choose. In other words, they control the speed instead of the bank controlling it. And psychologically, that flexibility can be extremely valuable. Now let's talk about something emotional, because this conversation is not only about numbers. For some people, paying off the house early represents freedom, security, and peace. No debt hanging over their head. And honestly, that emotional benefit is real. There's something powerful about owning your home outright, especially during uncertain economic times. So even if investing may mathematically produce more wealth, some people simply sleep better without debt. And that matters too, because wealth is not only about maximizing returns, it's also about building a life that feels stable and sustainable. Here's the truth nobody wants to hear. There is no perfect answer. The best mortgage depends on your discipline, your financial habits, your risk tolerance, your income stability, and your long-term goals. If you are highly disciplined and consistently invest the difference, a 30-year mortgage can potentially build more wealth over time. But if you know you are likely to spend the difference instead of investing it, the 15-year mortgage may protect you from yourself. And sometimes, the best financial strategy is the one you can actually stick to long term. At the end of the day, both mortgages can work. Both can build wealth. Both can become dangerous if misused. The real goal is not simply choosing the shortest loan possible. The real goal is building financial stability, flexibility, and long-term wealth. Because the people who win financially are not always the people making the most money. They are usually the people making intentional decisions consistently over time. And whether you choose a 15-year mortgage or a 30-year mortgage, that principle never changes. Disclaimer. This video is for educational purposes only and is not financial advice. Always do your own research before making financial decisions.